Today was probably one of the most significant days I've seen yet in the markets. And there is an old expression, no one rings a bell. And what that expression means is that there's no warning when there's a major top or a major bottom. It's not like somebody rings a bell and tells you you've got to figure it out. Well, in my experience, sometimes they do ring a bell. In fact, oftentimes, there are many bells that are rung. The problem is people don't hear them. Or if they hear them, they don't understand them. And that also happens in bubbles because bubbles always find a pin. The rate hikes are probably permanently on hold because the Bank of England refused to allow a potential crisis to unfold as a result of rising interest rates. And the crisis manifests itself in the UK pension system. See, the problem that pensions have had all around the world, this is not a situation isolated to the United Kingdom. So you're going to have these type of problems everywhere, including the United States. You have a lot of these defined benefit pensions where the pensions are obligated to pay out the pensioners certain amounts of money for the rest of their lives after they retire.
Now, our concern is that, of course, we have to bring inflation back down to target from a very high level. Now, other things equal, we think it will come down. The question for us is, are other things going to be equal? And really is about the question of, is inflation going to be persistent and become embedded?
Well, what pensions typically do is they invest a lot of money in bonds, and then they take the income from their bond portfolios and they use that income to meet their pension obligations. So despite the fact that the United Kingdom has record inflation and record budget deficits, they decided to cut taxes and throw gasoline on a red-hot inflation fire. I pointed this out when it happened that this was going to backfire, and it did, because the British pound started a free fall. It went to a new all-time record low. It traded below $1.04. And yield started to spike. In fact, as of yesterday, yield on 30-year British gilts was up to about 5%. And what was happening is the pension funds were getting margin calls on all the money they had borrowed. And so they were going to be forced to sell their gilts into a depressed market. That would have crashed the market. Great Britain was looking at a potential crash in the bond market, which would have sent yields soaring even more, and everything would have imploded. And so to prevent that financial crisis, the Bank of England folded. They pivoted. They decided to launch a new QE program. Remember, yesterday, they were committed to quantitative tightening. Now they said they will buy whatever it takes. They have now committed to another QE infinity in order to prop up the bond market. They now have to print British pounds to buy these gilts. The biggest problem is in America, but nobody bothers to figure that out. They just keep on buying dollars. And so that delays our day of reckoning. But that day of reckoning is going to come. It's not permanently delayed. It's just temporarily delayed until ultimately we're confronted with the same reality that the Bank of England was confronted with today. And they made the exact choice that I would have expected them to make, and they made the exact choice that I do expect. There's a lot of bond funds that are levered up as well. In order to maintain any kind of yield, they borrow money. They take on tremendous risk. That's why so many of these bond funds are falling so much, because they are levered. The only way they were able to make the interest payments was because they took on debt. The buyers of these products had no idea how much risk the underlying funds were taking. They thought they were buying something safe. Something is safe, but not if you lever it up. The minute you take on a lot of debt, it's not safe at all. So there's all sorts of malinvestments and risk-taking. In fact, one way a lot of people dealt with low yields on bonds is they bought more stocks. They gambled on the stock market going up because they couldn't get enough of return clipping the coupons on their bonds, so they figured they would buy more stocks, and those stocks would go up, and they would get that added return from stock market appreciation. Nobody, maybe other than Bear Stearns and Lehman Brothers, had to deal with the consequences of that hangover because the central banks bailed everybody out. And the message that was sent was, keep dancing while the music is playing. Don't worry if it stops, because the central banks got your back. maybe had more of the central banks allowed over-leveraged banks or other speculators to go bankrupt, that would have sent a much better message. And so people would have been more careful this time because they would have learned a good lesson instead of a bad lesson. One of the reasons that everybody was confident to take on so much debt during the environment of 0% interest rates is because they were confident if something ever happened, like today's crisis in the UK, that the Fed would bail them out, that the Fed's got everybody's back. Now, what has changed recently is a lot of people in the US have begun to question the Fed put. Did the put expire with Powell? Because Powell is talking so tough right now, as if, hey, we don't care if there's another long-term capital management. We don't care if there's a Lehman Brothers or a Bear Stearns or a Fannie Mae or Freddie Mac. We don't care. We don't care if there's another GM. Why didn't they do nothing? That would have been the right thing. In fact, the right thing would have been to shrink money supply along with this contraction in supply so that demand could come down with supply. But that was too much pain in the short run. The Federal Reserve didn't want to do that. So they did what they've always done. They've kicked the can down the road and opted for inflation over pain. That's what they're going to do this time. Except right now, the pain is being caused by inflation. And so they're pretending that they're committed to fighting it. But the Bank of England had a choice to make: inflation or the economy. Financial crisis. Inflation is a problem. A financial crisis is a bigger problem. But even though Americans didn't experience a price increase, they still didn't have the money to buy the phones. But it's even worse in Europe, where many of these countries are experiencing higher rates of domestic inflation.
Economic affairs. After the ECB announced an unprecedented rate hike yesterday, EU economic and finance ministers are gathering in Prague for an informal meeting.
So their cost of food, their cost of energy is going up even faster than in America. But in addition, the new iPhone went up in price too. So they just didn't have the money. And so foreign sales are probably even in greater peril than domestic sales. But this is not going to be a situation that's isolated to Apple. All sorts of companies that sell products that you don't absolutely need are going to have a lot of problems. That's why the companies that I've been investing in are companies that sell products that people need, not products that people want. Because when times are tough, you can give up the things you want so that you have money to pay for the things you need. It's only when you can cover all the things that you need that you have extra money to buy those things that you want. So the companies that are selling the things people want are in a lot of trouble because their customers are going to spend all their money on the stuff that they need. There were also big moves in the stock market. The Dow was up almost 550 points, but I don't think the stock market move was nearly as significant as the moves we saw in bonds, the dollar, and gold, because all three of those markets had significant outside days. And what an outside day is a technical pattern where on one day, the market goes below the low of the previous day and also goes below the high of the previous day and then closes either above that high or below that low. So we clearly have a long way to go to get that high. But the big difference was 1981 was the end of an inflation cycle. I think in 2022, we're really 1 year in to the inflation cycle because our cycle started in 2021. So we got a long way to go before rates come anywhere close to peaking in the United States. But clearly, a 7% mortgage was going to be a big problem for the U.S. housing market, which already has a lot of problems. Though I think the reversal that we had today in the bond market is going to probably put in a short-term up in yields and a bottom in bond prices, meaning bond prices will rise somewhat from here and yields will come down. But what investors don't understand is that inflation is going to get much worse as a result of what's happening. And the economy going into recession is not going to put out the inflation fire. It's going to fuel it because the next recession is going to come with a surge in deficits that are already surging based on the backup in interest rates that has already occurred. And as we go into recession, the deficits are going to explode